After the non-farm payroll data released on Friday, Hawkish sentiment overtook the financial markets, impacting the bond markets and precious metals. In today's episode, we're diving into the US non-farm payroll data, average hourly earnings and unemployment data, and what these numbers mean for the economy and your investments. Plus, we'll be covering the European Central Bank's latest interest rate decision and its impact on financial markets. Hi everyone, I'm Roy Güllüoğlu. Welcome to another episode of Market Update, featuring by Marketsall and Rationale. Before we get started, make sure to subscribe to the channel, and if you find this video helpful, please give it a thumbs up. And also, if you have a question, please leave as a comment to the video. We would be glad to answer. Yeah, so before getting into the details of data flow of last week, I would like to show you the chart that summarized what happened last week through the US 10-year yields. Here, as you can see, last Sunday we had received OPEC Plus decision. That was a major change, and after that on Monday we received IS manufacturing. I'll come up to the details of all these. Then JOLTS data, ADP unemployment, then up until non-farm payroll. As you can see, there's a downward trend for the last week in the US 10-year yield, and then non-farm data changed the game. So let's begin with the covering economic calendar and review the highlight events since our last video. First of all, the latest ISM manufacturing data revealed an unexpected acceleration in contraction in May as prices eased. These prices also, as you can see, the forecast was 60.9 was the previous mark, and the actual prices is 57. So as you can see, since prices came down, also PMI came into the contraction territory and coming down. That means that economy is under threat, plus prices are coming down. So why not cut rates sooner? And that's why market considered it as a more dovish. Then on Wednesday, the JOLTS data from the US showed that the job openings in US fell to around 80 million jobs in April. The softer than expected data boosted appetite in US treasuries and increased the probability of seeing the first rate cut in September. On Wednesday, the ADP report is expected to print around 107. So here you can see 173K, and as you can see, this is also previous number was 188, and it's coming down. Sorry, my bad. Sorry, 173 was forecast, and it came lower than forecast. It's in line with the the economy is under threat mentality. The Bank of Canada announced 25 basis point rate cut, which was expected. Then we received on Wednesday the ISM services data in May. It came at 53.8 and surpassing both the April figure and market expectations. So the headline figure is the highest since August 2023. While the prices sub-index declined compared to April, it remains in expansion territory. The new order sub-index reached its highest level since March. These were the details of ISM service data. And just to remind, we're here, let's say, with the ISM service data here, there's a jump that's due to the new order sub-index is also reached highest. That means economy is doing good. But the overall main trend of last week until the non-farm data is risk on. And ECB on Thursday, as widely expected, the European Central Bank announced a 25 basis point rate cut. It's meeting yesterday. It's meeting that day. And however, they raised its inflation target for this year and next. They warned the path to easing inflation could be bumpy, and they ruled out the July rate cut. and like two G7 central banks announced 25 basis point cut that week, like last week, marking the beginning of the easing cycle for major central banks. Since its founding in 1999, the ECB had never before cut if the Fed hadn't done so first. Like, it's the first time that ECB acted first. And about the upward revision in inflation, it might sound a bit contradictory actually. While they're like cutting rates, they revised their inflation target upward. They said, like, despite the progress over recent quarters, domestic price pressure remains strong as wage growth is elevated, and inflation is likely to stay above target well into next year. So for inflation, excluding energy and food, the ECB staff projected average of 2.8% in 2024, 2.2% in 2025, and economic growth is expected to pick up 0.9 in 2024 and 1.4 in 2025. Like, the one other important note about the ECB meeting was the governing council is not like a pre-committing to a particular rate path. They're not saying like, okay, subsequent rate cuts are gonna come or something. They said that they will be data dependent as usual. Especially due to this, the Euro USD did not fall after the rate cut news. Okay, it was expected, but so that message also kind of acted positively the euro. I mean, regularly we expect if a central bank cuts rate of yield of a currency, we would expect to see a decline on that currency, but it didn't happen due to especially this not pre-committing to rate cut path. And also current political situation is also really like highly influential on current stance of euro. They called an election in France, and this uncertainty this uncertainty affected negatively also EU indexes and EU bonds. And if I let me show you a few charts about those. First of all, let me show you how I follow Euro USD in a weekly chart. I had mentioned this symmetrical triangle, I think, is important. And as you can see, this is like a daily chart, and you can see the gap down opening here in Euro USD, which is unusual for currencies in general. This is mainly due to the uncertainty going on in euro. As you can see, on Thursday, the 6th of June, it was ECB day. As you can see, euro gained it was like around stable, but 0.18% higher at that day, as I mentioned. But after that, with the non-farm data, we saw this big sell-off candle. Then the continuation on Monday due to this uncertainty going on. And the negative part about this is the price came under the 200-day moving average, 50-day moving average. Like, all moving averages are broken down. And I'll be monitoring euro dollar like this. If it comes toward this way, I mean, this might also be traded like this, like with a strict game plan of you can short it, you can keep. Let me short position here. This might work as well. And for example, 200-day moving average, and if you bet on this close of gap, little bit upside of that gap, and here you can see up until this level, there's a 1 to 1.5 risk reward ratio game plan over here. That was just one type of game plan, but in general, I rather to wait and see breakout or breakdown of a chart pattern that I see. So the other one that I want to show, the DAX features, it's how I follow. It's like there is no actually clear chart pattern on it, but again, if you're a believer that this uncertainty will cause risk-off sentiment to get strength in the following days in Eurozone area, you can short those as well from the current price that I'm checking right now. And this high could be used like as a stop loss with the potential target of around these levels, which will coincide around like let's say 1 to 2 risk reward ratio, which makes sense. And one other thing that I want to show is the difference between let me come. This is the wrong one, I guess. This is the yield curve of euro side. I would like to show you the difference between 2-year yields in Germany and US yields. As you can see here, there's a nice consolidation over here, and I mean, you hear this horizontal level of 2.05 will be crucial for this one. And I mean, we would expect, if this goes down, we would expect to see more decline in euro dollar. And yeah. Now, getting back to the slides. Here, I would like to continue through. Just give me a moment, please. Yes. All right. On Friday, the highlight of last week, for sure, jobs data. And on Friday, we received non-farm payroll, unemployment, and average hourly earnings data. So before evaluating the numbers, I would like to give some important information about the non-farm payroll or job data, regarding the job data in general, and about the way that we should interpret the data. First of all, there are two different surveys for unemployment rate and non-farm payroll numbers. The unemployment rate is derived from the household survey, while the non-farm payroll is derived from the establishment survey. So one shows the perspective of the companies, which is non-farm side, and the other shows the perspective of households. That is why it might be natural to see some contradiction between the interpretation of both numbers. So about the interpretation side part, like we need to monitor the non-farm payroll and unemployment in the way to analyze if the real economy or the economic activity is deteriorating or not, while the average hourly earnings should be evaluated according to its contribution to the inflation, as data suggest the continuation of inflationary pressure that would postpone the rate cuts and put pressure on risky assets. Or if the data signals a good economic activity, that would provide room for Fed to hold rates high, which would also result in a pressure on risky assets. Now let's dive into the details of the data. For the headline non-farm figures, here you can see we saw a number of 272K, which is even higher than the top estimate of 258K. Those estimations are from Bloomberg surveys. And the highest employment growth was in healthcare and social assistance, with an increase of 83.5K. Let me show you here. This was the release document. Here you can see, and there are tables, tables that you can find details on it. This table B1 is the employees of non-farm payrolls by industry sector, and selected industry detail. Here you can see the contribution of each sector, and when you come here, these are K. As you can see here, for example, in the private education and health service segment, the healthcare and social assistance increased by 83.5K. That was the highest one. So yeah, On the other hand, the unemployment rate from the household survey rose from 3.9% to 4%. There will be a Fed meeting this week where we will receive new projections for rates, GDP, and unemployment. Like previously, the Fed projected an unemployment rate of 4% for the end of 2024. We have already reached that target with the May unemployment data. It will be important to see if the Fed decided to revise their projections upward or not. If they do, it could contradict with the idea of soft landing for the economy. That is why, like, I don't personally expect to see such shift from them. It's a challenging situation for them to manage, actually. I am at the same time also questioning the strength of the economy because like the number is really good, 272K. It's like higher than the high survey, but I keep questioning because the household data and also the previous week we had received some spending data, consumer spending data, credit card delinquencies, and those kind of stuff are a bit like challenging to evaluate, to be honest. But in a robust economy, we will typically see an increase in the participation rate. As you can see here, labor participation rate is down from 62.7% to 62.5%. Because like as you see, as the economy goes well, you expect to see more people to come and join to the economy because there are room to absorb those people, right? That should be the like simple mentality. But yeah, this might also indicate a shift in standards in like economic assumptions. I don't know, just as an example, it could be due to the impact of AI, let's say. I don't expect AI has a like that kind of fast impact on labor market, but just as an example, it could be due to the impact of AI reducing the need for extra labor, or perhaps other factors might at play. But yeah, that's the one reason that I question the due to participation rate. I also question the number of 270K numbers. So as a result, the non-farm data suggests a delay in rate cuts, only the headline number that I'm talking about. The increase in unemployment presents a contradiction, as I mentioned. But the question is, what could be causing contradiction between household and establishment survey? Personally, I think like the non-farm data will be revised downward, as I have mentioned in my previous videos a couple of times. Since the beginning of the year, the headline numbers have consistently been revised downward. Here is 2024. As you can see, in January, like in February, from first announced number, then the revised third revision, and this 97K shows the revision of January number, and 39K is February number. March is 7K positive, but when you go back to 2023 December number, there is a downward revision as well. And also not seasonally adjusted side, you can see those downward revisions. So as you can see, like those numbers are first initially announced, then final revisions are totally different. Considering the distortion in consumer spending within the last week PCE data, in the beige book it was mentioned that consumer spending is weakening. I believe that the downward revision will continue. The trend of downward revision will continue, and the non-farm data will eventually align more closely with the rising unemployment rate. Therefore, I still believe that any correction in indices, precious metals, or cryptos or commodities should be seen as a buying opportunity. But really, it's really crucial to approach this with a strict stop loss or well-defined trading plan. Why? My biggest concern, especially regarding the indices, is the potential shift from the belief in soft landing to hard landing, where economic activity comes under threat. If, let's say, Fed revises its projections in a way that threatens economic activity, this shift could become more likely, impacting market sentiment and economic stability. So, unlike the general market perception, I am personally being cautious on the so-called bad data leading to good pricing due to more rate cuts narrative. I'm skeptic on this one. I mean, the pricing, of course, is like that. Okay, since if rates comes down, the real yield will come down. Then investor will seek for other different opportunities. But a potential change in market perception wouldn't surprise me. That's why I'm just like strict. I'm strictly saying that like the game plan should be must. Like you should trade with stop loss, especially around this time. Like that's why building a proper building position with a proper trading plan that includes stop loss is pretty crucial, especially at this time. Like please be cautious. The narrative that rates will come down and risk on sentiment will return might not play this time as strongly as the general market expects. And lastly, about the non-farm data, the average hourly wages are above expectations. Here you can see the jump from the April to May, 0.2 to 0.4. The likelihood of a rate cut is delayed, and rate cut expectation shifted to December due to especially this our average hourly earnings data. That's my belief, by the way, about the non-farm data. Rather than headline number, I think average hourly earnings was much more influential compared to that one, because I think the market sees the contradiction between household and establishment survey. Thus, average hourly earnings has, like, first of all, inflation is priority for the market right now, and average hourly earnings is the way to interpret the path of inflation. That's why I think that was the main reason of this huge rise in US 10-year yields. So, especially like increase in average hourly earnings is like showing that the rigid service inflation that we had received in previous CPI numbers. And as you know, like this service inflation side is much more challenging. And yeah, as a result of the non-farm payroll data in overall, index future have shifted from positive to negative. The US 10-year yields went up. Euro USD is down. Also, in addition to non-farm data, political uncertainty affected a lot. Cryptos had a huge sell-off, especially like more like altcoins had a huge sell-off during the weekend. Yeah, I would like to show you a few charts that I was following. Here, first of all, let me go through US 10-year yield. Where are we and stuff? This 3-month SOFR futures. As I mentioned before, I prefer to follow 10-year yields through this one. Here, there's a really nice symmetrical triangle chart pattern established. And this day is the non-farm day. As you can see, if this chart goes down, that means yields are go up. And if we see a rejection from here, I would be monitoring a potential breakout from here. And yeah, this is real yields. This was the parallel channel that I was following with the huge volatility. As you can see, this level is like broken down, and like it was a fake broke down, and now still within the channel. And yeah, this is how I follow it right now. I believe like this level is, first of all, due to this horizontal line of 2.005, and also the upper band of the parallel channel. These levels are crucial to watch. And yeah, this chart is leading the precious metals, especially the XY. Same going on here, and this weekly symmetrical triangle is started to establish. Let's see if it will go like around this level, if you're gonna see a breakout. But yeah, that's how I monitoring it. And goals, for example, like when I'm saying like how in this environment I will be buyer of precious metals, and like I had said that, but with a strict game plan. Just as an example, here you can see in gold, we might expect to see a horizontal support level around this due to this prior support. And here at the same time, the concerning part for me is short-term moving averages are broken down, but still, as you can see, this is 200-day moving average, and that is the trend decision maker for me. But I believe like this, like a downward move, is like more like a mean reversion action, like. And I still monitoring this level, and if I would like to trade this, I would come to like a maybe like a shorter time frames. And but to be honest, like maybe I don't see a clear chart pattern in this one. If we see a potential jump from here, maybe a long game plan could be done. Or I don't know, if you were a buyer from here, if you were if you already were building a position, any test to like, I would be buyer from around here maybe, because of the short-term moving averages, since I'm building a position. But yeah, this might be a game plan if you would like to give a shot with a short stop loss, tight stop loss, because if it like breaks down from here, and as you can see, there's a, let's say, around like a 7.58% move between 200-day moving averages. You can wait and be like get position if it comes down to the 200-day moving averages, or give some portion of it. Yeah, it's a subjective issue. And here in the silver, I'm following this head and shoulder continuation chart pattern. Broke out, pulled back, moved well, and this is a weekly chart. This is 10-week moving averages. As you can see, it's being tested right now. In the daily, as you can see, we still didn't lose the short-term moving averages here. This gray one is 10-week. This blue line is 50-day moving averages. Rather than gold, I might give a shot in silver, definitely. Like, have a position, just stop below 50-day moving averages, maybe. That might be a good play. And as you can see, like, this kind of game plan has a 1-to-2 risk-reward ratio. And here you can see, it's debatable that it's a cup with handle, but I think it's nice, a cup with handle. There's a breakout, pulling back. As long as we hold the 5300 levels, I'll be bullish on this side as well. This is a daily chart, a game plan in US futures, maybe just below the 21-day moving averages, a tight stop loss. Yeah, this might be a good play. And cryptos here, sorry, like the debateful cup with handle was not US S&P futures. It was Bitcoin, because like here you can see there's a huge base, but the handle side is so low. Still monitoring here, nothing has changed. It did not impacted from the Nonfarm data at all at that day. Also in the weekend, all altcoin had a huge sell-off, but as you can see, on Friday there was a 2% decline, and on during the weekend, Bitcoin hold tight. Apart from that, as you can see, there is a head and shoulder kind of continuation chart pattern, and as you can see, the decline in price keep contracting, is 21% decline. 8.39%. Here less, 4.5%. And this, why I'm calling this, because as we see more contraction as the base, as we go to the right side of the base, we might expect to see a better breakout, and we should follow this with a volume. As you can see, while this contracting volume contract, this is called volatility contraction pattern. You can read Mark Minervini's book about this. It's his way of tracking the charts, and he would like to see also volume dry up while the chart, like the price, is contracting more and more as we go to the right side of the base. So seems good for me, and I expect to see I will be monitoring the breakout from this level for now. What was it? Let me give you an exact number. It's around like a 72K. That will be a powerful. But if you wanna have a early game plan, you can come to the 4-hour chart, and I don't know. You might. You can bet on this like a really small consolidation, but this is not my style. Yeah. And also, lastly, I would like to mention this Hang Seng Index. As you might recall from earlier rationale reports or my previous videos that we shared at Marketsall YouTube channel, I had mentioned this chart. Really nice bottom reversal, inverted head and shoulder, broke out, moved well, now pulling back, and it pulled back to the 10-week moving average plus 50-day moving averages. Those areas tested. For the ones who's looking to build a position, here might be if you had the position here, and for example, let's say this was your game plan, and I don't know, you got like a 1 to 3 risk reward from here, and now it's coming down. Since you have a bullet in your pocket, like, you can just give another shot. Maybe this might be a good game plan as well. And yes, so it's I think it's all I'm going to talk about this week, and hope you find this video helpful, and hope you enjoyed. And if you have any question, please let us know through the comments. You can just comment just under the video. And thank you for watching, and please consider subscribing and liking our videos to support us. And have a great week. Have a great day.